Welcome to Topic 3 of Ethics and Governance. We have met the MCCG in passing in the earlier topics. Now we are going to study it properly because it is the rule book at the center of Malaysian corporate governance. In this lecture, you will learn what the Malaysian Code on corporate governance actually is, how its clever apply or explain approach works in practice, the principles it stands on, and the concrete mechanisms it promotes inside companies. This is the most distinctly Malaysian topic in the course, so the names, bodies and laws here are ones you should know well and be able to use confidently. The textbook carries the full detail. In this video, let us focus on really understanding the ideas. Let me start with a question that gets to the heart of this topic. The MCCG recommends best practices, but here is the puzzle. It is not a law. A company can actually choose not to follow a particular practice in the code, and it will not be breaking any statute. So how on earth can a code that does not force compliance still manage to raise governance standards across an entire market? It sounds almost like a toothless rulebook. The answer lies in a genuinely clever mechanism called apply or explain, which we are going to unpack carefully today. So keep the question in your mind as we go. How does flexibility, when it is combined with transparency, actually push companies to behave better? Several actors work together to bring the MCCG to life, and it helps to see it as a partnership rather than a single rule maker. First, the Securities Commission Malaysia, the SC, issues and updates the code itself. It is the author. Second, Bursa Malaysia, our stock exchange, plays the enforcement role through its listing requirements, which compel companies to disclose how they have applied the code. So Bursa makes governance visible. And third, inside each company, it is the board of directors, and especially its independent directors and its audit committee, who actually put the code into practice day to day. So remember, the division of labor, the SC writes the code, Bursa enforces the disclosure, and the board lives it. No single body does it all. After this topic, you should be able to do the following. Explain what the MCCG is and who issues it. Describe the apply or explain approach, and importantly, judge whether a company's explanation is actually adequate or just an empty excuse. State the code's guiding principles and identify the key mechanisms it promotes, such as board independence, the audit committee, and integrity safeguards like whistleblowing. So we are moving from simply knowing what the code says up to being able to evaluate how well a real company is following it. Here is our path through the topic. First, what the MCCG actually is. Second, the apply or explain approach and how to test whether an explanation is good enough. Third, the principles the code stands on. And fourth, the practical mechanisms it promotes inside companies, including whistleblowing and codes of conduct. By the end, you will understand not just the code's words, but how it actually shapes the way companies behave. The Malaysian Code on Corporate Governance, the MCCG, is the country's primary guide to how listed companies should be governed. Let me give you the three defining facts. It is issued by the Securities Commission Malaysia, and it is modeled on international principles, particularly those of the OECD that we met in the last topic. And here is the most important characteristic. It is principles-based rather than rules-based. What does that mean in practice? It means the code sets out recommended best practices and expects companies to adopt them, but it does not carry the force of law in the way a statute does. There is no automatic legal penalty for departing from a single practice. Instead, The code works through disclosure and market discipline, which we will explain in a moment. So if you are ever asked what primarily guides corporate governance in Malaysia, the precise answer is the MCCG, not the listing requirements alone and not the Old Companies Act. The MCCG is the governance rule book. The others support it. The real engine that makes a voluntary code effective is its apply or explain approach. This is the mechanism that answers our opening puzzle, so let us look at it closely. Under the apply or explain approach, a company has two options for each recommended practice in the code. Option 1, it applies the practice. It simply does what the code recommends. Option 2, if it chooses not to apply a particular practice, it must publicly explain why and describe the alternative arrangement it has adopted instead. Now, pause and notice what this clever design actually achieves. On one hand, it preserves flexibility. A small family company and a giant bank are very different, and apply or explain does not force them into one identical mold. A company can depart from a practice when it genuinely has a good reason, but on the other hand, it demands transparency. A company cannot quietly ignore the code in silence. The moment it departs, it must account for that choice in the open, in its annual report, where shareholders, analysts, and the market can all see it and judge it. That combination, freedom to choose but a duty to explain in public, is precisely how a code that is not strictly law still raises standards. It trusts informed investors to reward genuinely good governance and to question weak or evasive excuses. The market, not a policeman, becomes the enforcer. Now, here is a practical and important skill. Not every explanation a company gives is a good one, and you need to be able to tell the difference. Let me show you. A strong, adequate explanation does two things. It gives a genuine business reason for departing from the practice, and it describes a real compensating safeguard. For example, suppose a company keeps the roles of chairman and chief executive combined in one person, which the code recommends against. An adequate explanation would say why perhaps the company is at a stage where unified leadership is valuable, and then point to compensating safeguards, such as a strong senior independent director and a board that is majority independent, so that one person's power is still checked. That is a thoughtful, honest explanation. A weak, inadequate explanation, by contrast, is vague, gives no real reason, or offers no alternative safeguard at all. It just says, in effect, we have decided not to, and that is that. So when you assess any company's governance statement, do not simply check the box that it explained. Read the explanation and judge whether it is substantive. That critical reading is exactly what the apply or explain system asks of investors, and it is what separates real governance from a paper exercise. With the mechanism clear, let us look at the principles the code actually stands on. The MCCG is built on a small number of guiding principles, and they all point in the same direction. The first is effective board leadership and oversight. The code calls for a board with the right balance of executive and independent directors, so that management can be genuinely challenged rather than rubber stamped. The second is the integrity of financial reporting and risk management. This is overseen by the audit committee, and it is about making sure the company's numbers and risks are honestly reported and properly controlled. And the third is meaningful engagement with shareholders, supported by transparent disclosure, keeping the owners informed and giving them a real voice. Notice that all three principles are really about the same underlying goal we have seen since topic 1, a board that is competent, independent enough to question management, and accountable to the owners it serves. The detailed practices in the code are simply concrete ways of putting these three principles into action. Let us turn from principles to the concrete mechanisms the code promotes inside companies, the actual machinery of good governance. The MCCG promotes several practical mechanisms, and you will recognize that each one is really a tool for controlling the agency problem we studied in topic 1, a way of keeping management answerable. First, board independence, having enough independent directors on the board and paying attention to how long they have served, because independence can fade with very long tenure and close personal ties. Second, the audit committee, composed mainly of independent directors, whose job is to guard the integrity of financial reporting and internal controls, to make sure the numbers can be trusted. Third, the separation of the chairman and chief executive roles, so that no single person holds unchecked power over both running the company and leading the board that is supposed to supervise it. And fourth, board diversity and a proper nomination process, because a board drawn from a wider range of backgrounds and skills tends to make better decisions and to challenge groupthink. Each of these mechanisms is a safeguard, a way of keeping management answerable to the board and the board answerable to shareholders. Two further safeguards deserve special attention because they build governance from the inside out. The first is whistleblowing. A whistleblowing channel lets employees report wrongdoing safely and, where appropriate, confidentially, so that problems surface early while they are still small, rather than festering until they explode into a scandal. In Malaysia, whistleblowers are supported by the Whistleblower Protection Act 2010, which offers protection against retaliation. The second is the company's own code of conduct. This is the company's internal rule book of ethical behavior, setting out the standards expected of everyone in the organization and turning broad principles into concrete day-to-day rules. Together, whistleblowing and a code of conduct help build an ethical culture. And remember, good governance depends as much on culture, on how people actually behave when no one is watching, as it does on formal structures and committees. Let me bring the key skill together. When you see a company's apply or explain statement in its annual report, your job is to decide whether it is adequate or inadequate. An adequate statement names the practice that was not applied, gives a genuine reason for it, and describes a real safeguard that compensates for the departure. An inadequate statement is vague, gives no real reason, or offers no alternative at all. Reading these statements critically, refusing to be satisfied by an empty "we chose not to," is the practical heart of how the MCCG works. It is how the market, rather than a policeman, holds boards to account. Let us see the whole topic on one map. At the center is the MCCG. Around it sit our main ideas. What it is, the SC's principles-based code, modeled on the OECD. The apply or explain approach, which combines flexibility with transparency and lets the market do the enforcing. The principles of effective board leadership, reporting integrity, and shareholder engagement. And the mechanisms it promotes: board independence, the audit committee, separating chairman and chief executive, diversity, whistleblowing, and codes of conduct. Together, these turn a code that is not strictly law into real, working governance. That concludes topic 3. Let me leave you with the essentials. The MCCG is Malaysia's principles-based code, issued by the Securities Commission. It works through apply or explain, which demands public transparency rather than compliance by force. And your skill is to judge whether a company's explanation is genuinely adequate. And it promotes board independence, the audit committee, and integrity safeguards like whistleblowing, supported by the Whistleblower Protection Act 2010. Please read the full chapter in the textbook for the detail and the references. Thank you for watching, and I will see you in the next topic.